You know what's nuts? It turns out that our old friend Kramer was right. Back on September 14th, I did a video titled, what did I title it? It's titled, What the Stock Market Does Every September is Shocking, Do This Now. I'll leave a link to the video here if you don't believe me, but back then, I said that if you were a short-term trader or you cared about the short term, September 17th is likely the date that you want to start selling or trimming your positions. You also want to consider opening up hedges against your positions and or against the market indices such as the NASDAQ and the S&P 500. So we'll revisit that trend because currently it's playing out perfectly so far, and I'll give you my assessment as to when I think all of this will be over. By this, I mean the market bloodbath that we are currently in. As I always say, I'm not Nostradamus, so I'm not going to predict the exact date that this will happen, but more so talk about the levels that I see in the charts. But before that, there are some extremely important news items and factors to consider for the next couple of weeks. Again, I know I say that every single video, but honestly, this week, there's just so much to wrap our heads around. I really have to go over this stuff with you, especially if you care about your portfolios. So far, we've been right on the money with the trends that we saw in September, and we need to monitor these things that I'm going to discuss with you right now for October and beyond. And then I'll give you a truncated list of stocks that I'm looking at currently, so you definitely want to stick around till the end. If you're new to this channel, welcome to The Traveling Trader, your source for concise, regular, non-BS market updates. If you get anything out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what stocks you are looking at because the market is looking juicy right now with a lot of deals on blue chip stocks. All right, in the Discord group, I outlined all of the events that I'm monitoring this week and next week. And I also sent out my watch list. By the way, if you want access to all of our watch list portfolios, trades, options, stocks, crypto, etc., link is in the description below. Come be a part of a vibrant community. In my view, well worth it. However, let's get right into the headlines. So OPEC meets today as of the time of this recording to decide whether they should pump more oil into the market or not. Obviously, OPEC countries are loving this surge in oil prices, and all indications point to them increasing production slowly, ramping it up slowly, but not giving the market enough production in order to cut prices down. Now, this is a very dangerous game that they're playing because this might lead to what's called demand destruction. And we could see demand destruction across many other industries, not just oil. When prices run really hot due to inflation like we're seeing with oil, and or when there are supply chain constraints like we're seeing currently with chips as well as other materials, the demand curve can start to tank sharply because consumers don't want to pay those prices, and or the stuff that they want to buy just is not available on the market. We're seeing this with the auto industry right now. Look at the sales of Ford and GM. There simply aren't enough chips to manufacture cars. The demand is currently really high, but demand is starting to fall because consumers are realizing, hey, there are just no cars for us to buy. They're not available. Demand destruction is something that economists fear because it wreaks havoc on the market. It's something that snowballs and becomes a negative factor on the broader markets overall. Another thing that's happening today as of the time of this recording is that the White House will unveil its China strategy. It's no secret that trade tensions with China have been ramping up. And then what's going on within China internally with Evergrande as well as the crackdown on some other companies like Alibaba, we could see an extreme downturn in the Chinese economy, which is the second largest economy in the world. The last time this happened was 2015, and that brought the markets tumbling down to correction levels. There's a Facebook whistleblower that's set to testify on Tuesday. Now, I'll tell you why that's not all a bad thing. Basically, I'm looking to buy the dip on Facebook. I want to buy the overreaction on Facebook. We see this time and time again with Facebook as well as other big tech companies. You have antitrust hearings, lawsuits, etc., but there just isn't enough there to litigate against those companies. And so the stock price drops, but it does not change the fundamental profit structure of the company. Right now, Facebook's stock price looks like a hot knife going through butter, heading down towards that 200-day moving average where I would likely load up on Facebook. Maybe load up is not the right term, but I'd start to nibble on long-term dollar cost averaging positions, especially that we see Facebook is also oversold on the RSI. We have the ADP employment report coming out on Wednesday, the jobless claims coming out on Thursday, and the September jobs report coming out on Friday. So a big week for jobs. And the next earnings season is officially kicking off this week, although the mega cap companies are likely to report earnings second and third week of October. And then of course we have the infrastructure bill, which now looks like it's kicked down the road to October 31st. The government is more focused on the immediate situation with the debt ceiling, They basically need to raise the debt ceiling or postpone the debt ceiling by October 18th, which is when government funding runs out. But if someone were to ask me right now, why is the stock market selling off? Obviously, it is a multifaceted, and the fact that the stock market was looking toppy, we've talked about it time and time again on this channel. You guys always make fun of my thumbnails and titles, but hey, look what happened to the markets. But if I was to sum it up into two issues, I would say that inflation and supply chain constraints are the two main issues right now that are rattling the markets. There simply isn't enough of what people want to buy right now, which is going to hurt earnings for sure. And the stuff that people want to buy is so high priced that it might, again, as I said, tank the demand for those items. Now, based on that S&P seasonal trend pattern that I shared on September 14th, it looks like mid-October is the time when the market looks like it wants to reverse. Obviously, every year brings a different set of circumstances, but here's why I think that could actually be the case. But there is one doomsday scenario that I will share with you from my personal perspective. See, with COVID cases dropping, the economy doing well, and with the Fed remaining very dovish on policy, there simply isn't anywhere to put your money. And I can see cyclical stocks raging on after October. Also, if the global economy finds a way to relieve the supply chain constraints that we see worldwide. However, because China is a very large player in the worldwide economy, as well as the supply chain of most countries in the world, if China's economy tanks and we haven't solved those supply chain constraints, then I could see us going down to a full-blown bear market or close to a bear market, a correction to a bear market. So between 10 and 20% is what I mean. However, if the world corporations come together to solve the supply chain constraints, the Evergrande situation ends rather smoothly with the Chinese government inheriting a large part of their operation, the housing market in China doesn't crash, then to me, this is a major buying opportunity here in October. All right, now onto the stocks that I'm looking at. The good thing is that if the S&P 500 closes at the 4290 level, then we will be in pullback territory, meaning an official drop from highs of 5% or more. We haven't seen that in all of 2021. And as I said before, that is rather weird. We usually see an average of 3 per year. We have seen 0 this year. I know it sucks to see a lot of your portfolios red. However, corrections and pullbacks are necessary. Just like anything else in life, a reversion to the mean is necessary before making another leg up. Now, because treasury yields are rising due to inflation, NASDAQ stocks are the hardest hit. NASDAQ right now is down almost 8%. We've seen a correction in NASDAQ last year, a correction being a drop of 10% or more, and it looks like we might be heading there again this year if it drops down to the 200-day moving average, which it looks like it's heading to at the moment. We did have a few hedges against the NASDAQ last month. We do have a hedge against the S&P 500 this month. Again, if you want to learn how to hedge or you want access to all of our plays, link is in the description below. And here are some of the stocks that I'm looking at, but not necessarily pulling the trigger on just yet. I think we can all afford to wait here. But just keep in mind, these are juicy opportunities. Do not fret. This is what you want. You don't want to buy at the highs. 10 years from now, you'll be ecstatic that you relish the opportunity to buy the major dips here. So we have a few stocks that are actually in bear market territory, meaning that individually they've dropped 20% or more. Facebook is not quite there yet. It has dropped 15%. But as I said earlier, Facebook is one that I'm really intently looking at. I'd relish to buy the dip on Facebook at the 315 level, which is at the 200-day moving average, or even the 300 level, which is at the 300-day moving average. We have an open short on Twitter in the form of a call spread that's up 15% on the day after it broke this wedge here to the downside. I'm looking to see where Twitter finds support, but I'm not buying Twitter just yet. Shopify is one that I load up on major support levels. Currently, it broke the 200-day moving average. I'm also monitoring Shopify. Coca-Cola is finding support here at the 300-day moving average. Oversold on the RSI. This is definitely on my watch list. If NEO drops to the $30 level again, a point which it did 3 times in the last year, I will definitely look to be adding more NEO. I will also entertain selling a cash secured put if it drops to that $30 level. That usually is very easy money. We did it 3 times the last year. Nvidia is heading to the 100-day moving average, so looking to see where that finds support. The semiconductor ETF SOXS also heading to the 200-day moving average, looking to see where that finds support. There is a leveraged 3X ETF that's based on SOXX, and that's SOXL. This one looks like it might head to the 300-day moving average at around $33. So we'll definitely add a short-term position on SOXL if it does get there. And then obviously don't forget the indices. These are the easiest things to invest in for the long term. The Qs, which tracks the nasdaq, currently breached the 100-day moving average. You could start the dollar cost average here, but if it hits the 200-day or 300-day moving average, I'm definitely loading up for the long term. SPY is the same thing. This is the ETF that tracks the S&P 500. Currently breached the 100-day moving average at the 200 or 300-day moving average. I will load up as well. There are too many opportunities to name, but my general approach is going to be what's called a barbell approach, right? So there are two main things that I'm going to be investing in. One are cyclical stocks, because cyclicals tend to do well in high inflationary environments. So think of things such as travel, leisure, as well as discretionary spending stocks like automobile stocks. And then the other end of that barbell is going to be dedicated to mega cap growth stocks, basically NASDAQ stocks like Amazon, Google, Facebook, Apple, etc. As I said, by mid to end of October, I could see the market start to reverse on the way back up, unless what's going on within China becomes a full-blown economic collapse, which we definitely don't want to see. Anyway, traders, that is it for this video. Remember that corrections and pullbacks are necessary for the market to reset. Don't wallow in sadness. Make sure that you guys buy the dips on things that you have high convictions on. Leave it in the comment section below. Let me know what you are buying the dips on. Let me know what you think of the current market landscape. Hit that thumbs up button if you got anything out of this video. If you want access to all of our trades, link is in the description below. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.